All right, let's dive right in. Today, we're talking about the most fundamental partnership in the entire financial world: stocks versus bonds. I'm telling you, understanding how these two play together is absolutely key to any investment strategy. And it really all boils down to one single question.
And that's it. That's the question. Everything, and I mean everything we're about to talk about comes right back to this choice. Your answer is going to define the risks you take, the rewards you can hope for, and pretty much your entire game plan for building wealth. This is the heart of the difference between a stock and a bond. So, first up, let's meet the more famous, maybe the more exciting partner in this duo, the owner. And in the world of finance, being an owner means you're holding a stock. When you buy a stock, you're not just getting some line item on a screen. No way. You are buying a tiny piece of an actual business. You become a part owner, an equity holder. And what that means is your financial fate is now tied directly to the success or, the failure of that company. So, as an owner, how do you get paid? Well, the main way is through what's called capital appreciation. That's just a fancy way of saying the company does well, its value goes up, and you can sell your piece for more than you paid for it. Simple enough, right? You might also get dividends, that's your little slice of the company's profits. And this is a big one, you often get voting rights. You actually get a say in how the place is run. This is why we call stocks the growth engine of an investment portfolio. Okay, so now let's meet the other partner, the quieter, maybe more predictable one, the lender. And the lender is represented by the bond. Buying a bond is a whole different ballgame. You're not an owner at all. You are a lender. You're basically loaning your money to a company or even the government. In return, they give you a formal, legally binding IOU. It is a rock-solid promise that they're going to pay you back. As the lender, your goal is pretty straightforward. Get your original loan, that's the principal, paid back in full on a specific day in the future called the maturity date. And while you wait, you collect fixed interest payments, often called coupons. It's a predictable stream of income. But here's the trade-off. Unlike a stockholder, you have zero say in running the company. You're not the growth engine, you're the steady anchor. So, we have our owner and we have our lender. But to really truly get their relationship, we've got to put them through the ultimate stress test. What happens when everything goes wrong and a company goes bankrupt? This table shows you what's called the pecking order. It's the legal lineup for who gets paid when a company fails and all its stuff is sold off. And just look at that liquidation priority. Bondholders, as creditors, people who are owed money, they're right near the front of the line. But stockholders, the owners, they're dead last. They get whatever is left over, the residue, which, let's be honest, is often nothing, absolutely nothing. Let that sink in for a second, because this is the single most important rule that defines the risk and reward here. Lenders get paid before owners. As the lender, you've got a much stronger legal claim. As the owner, you're taking the biggest risk in the hopes of getting the biggest reward. So you might be thinking, whoa, if stocks are that risky, why would anyone ever want to be an owner? And if bonds are so safe, why not just be a lender? Well, the answer is that inside a portfolio, they aren't enemies. They're actually a really powerful team. And this chart shows you exactly why investors are willing to take that ownership risk. Just look at the historical returns. A big basket of U.S. stocks has delivered more than double the annual return of a similar pile of high-quality bonds. Over the long haul, that kind of difference is absolutely massive for building wealth. That gap in performance, that 5.6% difference, actually has a name. It's called the equity risk premium. You can think of it as the bonus pay you get from the market for being brave enough to take on the risks of ownership, the risk of being last in line when things go bad. It's your compensation for funding the growth and innovation that drive the economy. So, here's the big takeaway. They have different jobs on your financial team. Stocks are your growth engine, the part that's designed to crush inflation over many years. Bonds are the stabilizer, there to smooth out the bumpy ride. In fact, you could even say bonds act as psychological ballast. Their stability is what can stop you from panic selling your stocks when the market gets scary, and that is absolutely critical for long-term success. But, this classic partnership isn't always a walk in the park. In the last few years, the economic climate has really put this relationship to the test in some new and pretty challenging ways. Okay, this next concept is so important. Think of interest rates and bond prices like they're on a seesaw. There's an inverse relationship.
When new bonds start getting issued with higher interest rates, that older bond you're holding with its lower rate, well, it suddenly looks a lot less attractive. So its price has to fall. Simply put, when rates go up, existing bond prices go down.
And that brings us to the big modern challenge. When there's high inflation, what do central banks do? They raise interest rates. And as we just saw, that's bad for existing bond prices. But high rates also make it more expensive for companies to borrow and grow, which can hurt stocks too. So you end up in this situation where both of your key players are getting hit at the same time. The bond stops being that perfect stabilizer, and that has seriously challenged the classic balanced portfolio.
Which brings us right back to our financial team. Look, the fundamental roles of the owner and the lender, they haven't changed, but the economic field they're playing on definitely has. So the real question for every investor today is this: as the rules of the game keep evolving, how are you going to make sure your team, your unique mix of stocks and bonds, is balanced to win?